I want to say for all your listeners that Yardeni Research is seriously considering issuing convertible bonds at 0% and buying Bitcoin. I mean, if MicroStrategy can play that game, why can't anybody play that game? And, so Bitcoin goes up and then my stock price goes up and then I issue more stock and I buy more Bitcoin. So the guys discovered, the fountain of youth. I mean, it's El Dorado.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunne.
Thanks for that introduction, Niels. Today, I'm delighted to be joined by Ed Yardeni. Ed is president of Yardeni Research, and he's a well-known commentator in the markets. He was on Top Traders Unplugged with us last year, so we won't go back into the full intro. But Ed, great to have you with us again. How are you?
I'm just fine, thank you.
Good stuff. As I said, you were here last year, and you were bullish back then, and markets have continued to rise. So it looks like your roaring 20s thesis is playing out pretty well so far.
So far, so good. Only a few more years to nail it here, so...
Well, I saw in one of your recent commentaries talking about the possible roaring 30s as well. So I thought I was, wondering, are you getting carried away, or do you see a kind of a bullish outlook as far as we can see?
Sure. I may be getting carried away. You never know about these things, but and people remind me that the roaring 1920s ended very badly, and they ended badly because the U.S. Congress and the President signed onto a bill called the Smoot-Hawley tariff that shut off world trade. That was done in May 1930, and arguably that's what caused the Great Depression and the Great Crash, and set us up for a pretty awful period there in the 1930s. And we're probably going to get a test of something like that in the next 6 to 12 months, because under Trump 2.0, tariffs is going to play a big role, and the incoming president's already said that he wants a 10% across the board tariff, maybe even 20%. I think he's looking to raise some revenue that way. But the problem is that could just start a trade war. So I think there is that kind of risk, but I don't think that's the way it's going to play out. I think Trump is using tariffs as a stick for negotiating fair deals for the U.S. If that's correct, then I think we'll get through this latest threat to the economy. The previous threat was tight monetary policy. And if that's the case, then I think the economy should continue to grow through the end of the decade. And technology plays a very big role in my roaring 2020 scenario. There's no particular reason why the technology revolution, the digital revolution, isn't going to continue to play out in coming decades.
Good stuff. Well, obviously you touch on the possibility of tariffs from Trump, and I guess the change of administration is probably the big change in markets, and people don't know exactly. I mean, there's multiple dimensions to Trump's policy platforms. You mentioned tariffs. Obviously, there's an expectation of tax cuts, or at least extension of existing tax cuts, possibility of supply side measures, unleashing animal spirits. That's the hope as well. And then possibility of deportations and reduced immigration flows. So it's quite a mix. I mean, of those, do you expect we'll see all of those, or how much of each of those do you think we'll see?
Yeah, the way you laid it out can really make your head spin. There's a lot of moving parts here, and they're moving. They could move pretty rapidly. It seems that the Republicans know that they've got maybe 100 days to get all this done, because once these things get a little bit stale, you start to see that political cohesion, particularly among Republicans, starts to fall apart. And then, of course, they really only have 2 years, because then there's the midterm elections. And somehow or other, administrations always manage to annoy enough people in the first 2 years of their new administration, so that the people vote for gridlock. They vote for checks and balances. They said, we want to give the other party more power in Congress. So that's the way it's played out in the past. So they don't have a lot of time to get a fairly ambitious program through, and they may very well try to do all these things at the same time, and there could be unintended consequences, both good ones and bad ones. The good ones would be that, hey, hitting our friends and allies and maybe others that we're not so friendly with tariffs does work. They respond pretty quickly, and we get agreements, and the world is safe for relatively free trade. But it's kind of like giving a sick patient a whole bunch of medication. Let's try all these medications and see how they work. And the doctor forgets to look on the computer screen to see how the interactions, and there could be some pretty nasty interactions. But on balance, as a doctor of economics rather than as a doctor of medicine, my conclusion is, on balance, I think it'll be a positive. I think the tax cuts will provide supply side incentives. Deregulation, the same story. Tariffs, not so much. So we'll see how that plays out. And then the fourth thing is the impact on the deficit of all this. It looks as though this incoming administration has calmed my friends, the bond vigilantes, down a bit by telling them, we're going to have Elon and Vivek deal with cutting spending and maybe come up with some revenue ideas. But those are kind of the moving parts.
And yeah, you mentioned obviously the deficit, and you're well known for coining the bond vigilantes phrase. And the last time you were on, I think it was around October of last year. So yields were rising and then ultimately came back down. So far the market, coming into the election, the Trump trade was the steepener, sell the long end. Since then, the market has kind of calmed down a bit. I suppose the appointment or proposed appointment of Scott Bessent seems to be part of that. And I know you've highlighted that Scott Bessent seems to be a fan of your work as well. He's referenced your Roaring 20s thesis.
20s,
so,
yep.
Do you think that's part of the reason markets are more sanguine on the deficit for the moment? And what do you expect from him in that respect?
Yeah, I think Trump bought some time and sort of allowed the bond vigilantes to back off and give the administration some time, because they are talking about trying to rein in the deficit. Scott Bessent is talking about going from 6% deficits, 6% of nominal GDP to 3%. Notice he never said over what period of time. Usually the government budgets are extrapolated over a 10-year period of time. And I think, if they could make a convincing case and the Congressional Budget Office signs off on the idea that they've made some changes on the outlay side and the receipt side that'll get us down to 3% of nominal GDP, I think the bond market can live with that. I don't think anybody realistically thinks we're going to balance the budget. So that's that's not a goal that anyone is seriously thinking about. But I think by having this DOGE committee, this Department of Government Efficiency, and apparently Vivek and Elon have already started to walk the halls in Congress to see what's doable. But I think they're also going to focus on maybe what assets can the government has that can be leased and raise some money that way, not just oil, but maybe minerals as well. And then the fact that Trump appointed 15 people to run the various departments in the government, 15 people who are basically clueless about about their departments, but their marching orders are: one, you have to be loyal to Trump and follow his lead, and two, you have to do everything you can to fire people that we don't really need and to cut the budget. So I think the bond market is buying into that right now, but it could take a while for the bond market to assess whether that's real or not real. And so for now, I think the bond vigilantes are kind of standing back.
And I mean, you could, if you look at it, I mean, the bonds started to come under pressure after the Fed cut in September. So it's not just the Trump trade that kind of caused an ease in the bond market. It was obviously the Fed cutting in September, so there is a sense that maybe that was unnecessary. That they seem to be lining up again in December. But what's your sense on that?
That's been my view. My view has been that there was no need to cut the Fed funds rate by 50 basis points. If they had this burning need to just demonstrate that they were done raising rates and that they're starting to move in the direction of easing rates, they could have just done 25 basis points. But no, instead they did 50. But even more than that, they signaled that this was just the beginning of several rate cuts over the next couple of years, and that they were on balance, on average, they concluded that the correct Fed funds rate, the neutral Fed funds rate, the nirvana rate was 2.9%. And look, they have this dual mandate of keeping inflation down close to 2% and having full employment. I think 4% on the unemployment rate is about full employment, and that's where we are now. So what is the rush to lower interest rates? And so we were critical of that. And then, as a matter of fact, last week, Jerome Powell basically conceded the point and said that there's no rush to lower rates given the strength of the economy. Well, I think we could have said that a couple of rate cuts ago, but it is what it is. If they do cut by another 25 basis points, it's not the end of the world. It's 100 basis points from where they started. It wasn't really necessary. And what are the bad consequences of that? Well, the bad consequences is we might get a melt up in the stock market, which is great on the way up, but melt ups imply meltdowns, and that would be the risk. And look, we've got lots of speculative juices flowing. We got Bitcoin at 100,000. We got some of these ARK funds, Cathie Wood's ARK funds, that are getting hot again. We're seeing the stock market at an all-time record high, valuation multiples getting close to where they were right before the tech wreck in 1999. So there are speculative excesses out there.
And you mentioned the possibility or the likelihood of another rate cut. It seems to be what they're saying. And I mean, we had Chris Waller also speaking last week. We're recording on the 12th or 10th of December. He seemed intent on cutting rates, or at least that being the direction of travel over the next while. But obviously the big thing that the Fed is kind of refusing to engage on is the impact of the potential policy mix from Trump. Obviously Powell sidestepped that at the last FOMC conference. I mean, do you think that's a bit naive on their part? Or, I mean, surely this is the big thing that's coming from an economic policy perspective.
Well, Alan, you and I are exactly on the same wavelength here. That was another criticism that we had about what the Fed's been doing here is like, are they not looking at the calendar? Are they clueless? I mean, September 18th was just a couple of months, that we were going to get the election, and they had no idea who was going to win. Nobody seemed to have an idea who was going to win. So we really had no idea whether we would get, Biden 2.0 with Kamala Harris and have even more government spending, or were we going to have a bunch of tax cuts? Either way, there was concern that neither side was particularly interested in talking about the deficit. And so, does fiscal policy not matter to the Fed? It should matter. It's certainly one of the reasons that inflation took off in 2022 and 2023. And for the Fed to accommodate inflationary fiscal policy is not a good idea. So again, I don't understand why they cut in the first place. And once they did cut, why they seem to promise that they were going to do some more. Look, between now and the December 18th, 17th, 18th meeting, there's going to be a couple of more economic indicators, a couple of inflation indicators. And if they turn out to be concerning and suddenly they ruffle some of the feathers of the doves at the Fed, they can always call somebody at the Wall Street Journal and say, we got a scoop for you. We're probably not going to lower interest rates after all. Just don't attribute it to us. So we'll see between now and December 18th if there might be a Wall Street Journal story kind of guiding the market to maybe there won't be a cut after all. I mean, I think Powell tried to guide in that direction when he said that we should be in no rush. Well, if you say you're in no rush and then you rush to do another 25 basis points, that's kind of inconsistent. So he may have actually tried to guide us and we just weren't listening.
Yeah. And I mean, do you think the Fed will be true to their word in that sense that they won't make any major adjustments to their dot plot or forecast until we actually see, the details of policy under Trump? Or do you think we might see an adjustment in those dots by next week?
Well, Powell was in early November, right after the elections. Powell was asked at his press conference. This is after they lowered by 25 basis points. He was asked a few times, are you factoring in fiscal policy? And he said, well, we're not doing that. We don't know what fiscal policy is going to be, so we can't model it. Meanwhile, the stock market investors are modeling it all the time, thinking about what might be the consequences. And there's got to be some assessment of probabilities of these kind of scenarios. So I think they're working on a credibility problem if they don't kind of stick to the data. And the data right now shows the economy is doing just fine. We're basically at full employment. Inflation's come down pretty close to 2%, but it's not quite there yet. And so that's partly because some components are turning out to be kind of sticky and stuck around 3 to 4%, which is not a good thing if some of the other components that have brought inflation down, like durable goods inflation, for some reason, don't continue to do that. And we know that, for example, used car prices are starting to go up, and that's been one of the contributors to lower inflation is used car prices coming down after they surged during the pandemic.
Yeah, so the sense now is that core is going to be a little bit higher than maybe it was thought to be earlier year by year end, but the general trajectory is still in the right direction. And I mean, we still haven't seen the full impact. People are still expecting more of a weakness in the housing component to bring that down. I mean, taking it all together, I mean, if you were forecasting inflation kind of next to 12 months, do you think it'll be sticky around current levels, or would you still expect it to come down more from here?
Yeah, I think it's going to be sticky here, which is a sticky problem for the Fed because they were pretty adamant that they wanted 2.000%. It's not necessarily like pi in mathematics, but they made it sound like they needed to do that in order to maintain their credibility as inflation fighters. And for them to kind of make it a little squishier and say, well, we can live with 2.5 to 3%. That's not gonna fly. If they had just kept the Fed funds rate at a restrictive level, then namely 5.25%, 5.5%, and there's precious little evidence that it was really all that restrictive after all. The economy was continuing to grow. We've seen speculative bubbles here and there. So they do have a credibility problem building up here. And then we wouldn't want to see them kind of suddenly realizing that and overreacting the other way, which is what happened in 2022 when they realized they had an inflation problem.
Yeah, so as you say, the economy is still growing very, very robustly or reasonably robustly, notwithstanding the level of rates. So, there is this debate in market, is monetary policy restrictive or not? And I think, as you say, the Fed was pointing to about 2.9%. If you look at the dots, that was the implication. I mean, that's been revised higher over time. It was 2.4, 2.7, 2.9. Good chance it might get revised a bit higher. But I mean, where do you see it neutral? I mean, I know it's very hard to, or what range would you put around it?
Well, again, I think we have to be empirical about it because now we're talking about the so-called neutral federal funds rate, at which it's nirvana, right? Inflation's 2% and the unemployment rate is around 4%, which is consistent with full employment. We're there. So from that standpoint, maybe the Fed funds rate is exactly where it should be, maybe right around 5%, not around 3%. I mean, it's a 200 basis point difference. It's quite a stark difference indeed. But empirically, I think I'm right so far that the Fed funds rate seems to be just about where it should be. Now, as you mentioned, on December 18th, we're going to get their latest quarterly summary of economic projections. It'll be interesting to see how they're changing their view of the economy. And I think they will raise the long-term federal funds rate, the neutral rate is, as we're calling it. But it is a fantasy rate. It doesn't exist. You can't measure it. It's totally theoretical. When I started college, I started out in physics, and it was too hard for me, so I went to economics. And the only thing I remember, which I thought was pretty cool, was the Heisenberg uncertainty principle, that if you know where an electron is, you don't know how fast it's going. And if you know how fast it's going, you don't know where it is. In the case of the fantasy neutral rate, we have not a clue where it is. We don't know whether, and we don't even know if we knew where it was, it could be something different in 6 months. I think if you ask most economists, they'd say we can't measure it. We have an opinion of what it should be, but it's not based on anything other than our gut feel. And oh, by the way, 6 months from now, after I tell you what it should be, now it could change. We don't know that it doesn't move. I mean, it's got to move. Nothing in the economy just kind of stays stable. I mentioned the mathematical variable of pi. What is it? 3.14, and then so on. Did I at least get those digits right? I think I did. That's a constant. There's nothing to say that the neutral rate, even if we knew it was 2.9%, that's a constant. So it's a fantasy and it's useless.
I mean, taking all what you're saying together, I mean, it's possible that if they cut again, policy is less restrictive or even maybe not even restrictive anymore, and the economy already has decent momentum. And on top of all of this, we have, possible stimulus to come from Trump. So the implication is that, we could have a reacceleration potentially in growth, and the Fed might have to do an about turn. Presumably, it would be very reluctant to do that. But I mean, if you were to put a percentage likelihood on that scenario, how likely would you say that is?
A scenario where they do what?
That growth proves to be stronger and inflation sticky, and they end up tightening again next year.
That's my roaring 2020 scenario. But my roaring 2020 scenario is based on productivity, and productivity is like fairy dust. It makes everything better. If you get better growth in productivity, it goes straight into real GDP. If productivity grows at 3% instead of 2%, that extra percentage point goes right into real GDP. Real GDP's arithmetic is one of the most simple formulas in economics. It's the growth rate in the labor force, how many people are actually working, and then what's their productivity, what's their output per person, and that gives you GDP growth. So if the population and therefore the labor force is growing, let's say at 1%, and productivity is growing at 2%, you got 3% real GDP growth. In my scenario, I could see productivity growing 3%, maybe even 4%. Let's not get too carried away. Let's just say 3% instead of 2%. So 3% productivity growth plus 1% labor force growth gives you 4% growth instead of 3%. That doesn't sound like a lot, but it compounds and it makes some magical things like inflation remains moderate simply because unit labor costs, which is hourly compensation divided by productivity, unit labor cost inflation is the underlying inflation rate in the labor market. That goes down. Wages relative to prices, real wages track productivity really well. In a competitive marketplace, which we still have, the rising productivity does in fact boost real wages. And then, of course, it's great for profit margins. So again, win is what you get with the productivity, and you don't get inflation. So I think we could have the best of all worlds, a strong economy with low inflation, real wages going up, that doesn't require the Fed to do anything. Just leave the Fed funds rate where it is here. Now, of course, there are alternative scenarios. That's my base case, but we could have a surprise on the inflation side. The sticky areas could remain sticky, and we could have some problems on the less sticky areas of inflation. And at the same time, we may come out 6 months from now and the bond market concludes, you know what, they're really not doing anything about the deficit. So you have that plus an inflation scare, and suddenly the Fed has to consider raising interest rates. So it's not out of the realm of possibilities.
And on productivity, obviously the productivity numbers have shown a rebound in the last kind of 2 to 3 years, but prior to that they had been low. So there's kind of, some people might suggest, okay, don't extrapolate what we're seeing in the last 2 years, maybe average out over the last 4 to 5 years. Now, I know you look at the minutiae of all of this quite closely in terms of unit labor costs and margins, etc. But I mean, at a high level, what do you think the narrative is? I mean, you mentioned the digital economy. Is it just that, the greater adoption of the digital era, or is it AI, or what's fueling the productivity, do you think?
Well, first, with regards to productivity, the data that's available, I always say that whatever data supports my story is good data. If it doesn't support my story, it's bad data. And so far, the productivity data has been supporting my story. A lot of people question, how do you even measure productivity? But what we do, there is a series for it, and try to look at it and see whether it makes sense. But actually on a 5-year trailing basis at an annual rate, productivity growth bottomed at 0.5% at the end of 2015. Now, the latest number, which would be for the third quarter of this year, that 5-year trailing or 20-quarter trailing productivity growth rate is 2%. So it's quadrupled. That's pretty impressive. And you're correct. 2% is kind of the historical average. So saying that we've gone from 0.5 to 2% is like, okay, we've just kind of normalized. But it's nice to be normal. I mean, it's better than 0.5. And if we're right that the technology story is going to drive productivity even higher, and let's make it realistic, 3%, not 4%. That's more economic growth and more downward pressure on inflation. With regards to the technology story, I think we've, we know from reading our economic history that there was an agricultural revolution a few centuries ago. There was followed by an industrial revolution in the 1800s and 1900s. And now I think we're in a digital revolution that arguably started around 1950s when we had the IBM mainframe. Then along the way, we had smaller mini computers, then PCs, laptops, the cloud, and here we are with AI. In the context of the kind of historical evolution of the digital revolution, I would say that it's all about data processing. How can you take more and more data and process it more and more rapidly to come up with some important conclusions? And so from that standpoint, AI is really just a continuation of data processing, where we're now able to process so much data so quickly and relatively cheaply with basically supercomputers. I mean, NVIDIA chips, when you put them all together, allow for very, very rapid computing. And so what does all that means? Well, somewhere along the lines, not too long ago, somebody figured out, we can process so much data so quickly now. Why don't we just design some programs, large language models, that can interpret that data for us, come up with some conclusions? And so that's really what AI is all about. Now, it's totally useless if you use these models with the data, all the data that's available on the planet Earth. Plug it into the internet and it'll be garbage in, garbage out. It'll use garbage information and it'll generate garbage information. And it could very well make the internet kind of like the ocean. There may have a lot of areas of pollution that aren't good. However, if you take your models and just put in your own corporate data, or you buy some data that's is clean, you can get a tremendous amount of power from that kind of data processing, and that's where we are. So now that allows us to have autonomous driving, allows us to have humanoid robotics, just more efficient robotics, generally speaking. I think it is a game changer in productivity.
I mean, there are other interpretations of the productivity data. Like some people suggest, it was productivity kind of slumped a bit after COVID. It was, a lot of workers moved jobs and now they're settled in, so they're more productive. I saw somebody else making the argument that, there was a Gallup survey, I think, of employee sentiment. A lot of employees feeling like they've been working harder than ever, that maybe they were asked to do more during COVID and that's kind of continued, and that accounts for the productivity. Is there any truth in any of that, or are they kind of peripheral kind of explanations?
Well, those are kind of anecdotal issues that you make a list, and then you make the positives and the negatives, and then maybe the third column is the actual data and how the economy's actually performing. So if you got 5 negatives and 5 positives on whether productivity is making a difference, and then you look at the data and the data suggests that it is making a difference because we're getting better real GDP growth, which we are around 3%, and we're getting lower inflation, which we are. Wages are rising faster than prices for the past year and a half, 2 years. And profit margins are expanding. So check. We've got a lot of data confirmation that the positives are outweighing the negatives. I would never dismiss, that kind of analysis. You have to be balanced when you're putting your story together. But I actually like to start with the data and then come up with the explanations and see, well, which ones are working.
And one of the reasons the US is attracting a lot of inward investment, at least in the industrial manufacturing side, is low energy prices and low gas prices. Is that part of like a competitive advantage, at least relative to Europe? Is that part of the productivity story or not?
I think it's very much a part of the productivity story, because it turns out there's data suggesting that one of the most productive industries in America is fracking. We're not using too many rigs right now, and yet we're producing oil at a record 13 million barrels per day, and we're doing that because the frackers go into the same hole that was depleted, and they're figuring out ways to move the pipes around in such a way that they find more oil and gas. So that's been a very productive area, and of course that there's an abundance of oil and gas in the United States. We're now a net exporter. We're going to be under the Trump administration exporting a lot of liquid natural gas again. And that does give America a competitive advantage, because energy is an important part of production, especially now with artificial intelligence. We need to have a lot of electricity, and we're going to need to generate that with natural gas, maybe some still oil, but certainly with natural gas.
And I mean, you label this bullish phase the roaring 20s, which obviously kind of makes people think back to the 1920s. But the other obvious parallel is the 1990s, where we had this productivity boost in the kind of mid to late 90s, and Greenspan took advantage of that by not tightening during that phase. I mean, in that period, what was behind? I know we had the internet, but the internet kind of came in late 90s. With the benefit of like looking back on that now, what underpinned that productivity boom?
Well, again, I can make sense of that in the context of this digital revolution. In the late 1990s, the revolution evolved to desktop PCs. I worked as the chief economist and strategist at Deutsche Bank in New York City in the late 1990s on 52nd Street. And we had a nice office building there. And when you walked down the halls, you had to be very careful not to trip over a Dell box. Suddenly, everybody was getting computers. A few years before that, nobody, 1 or 2 people got computers, and everybody was jealous. But the company wasn't going to spend the money on computers. And then suddenly, in the late 1990s, everybody got computers. We needed to have a few hundred people in the IT department because they had to install all these computers in the offices, and then they had to install the Microsoft Office into these computers. And that's really what created the productivity. Is we sold a lot, Dell sold a lot of boxes and Microsoft sold a lot of software. But if you think about it, the application that was available at the time were pretty limited. It was basically Excel and Word. So if you had a whole bunch of secretaries on selector typewriters, IBM selector typewriters, you got rid of them, and everybody kind of was on their own typing the reports on Word. So that was a big productivity enhancer for that particular application. And then if you had a whole bunch of bookkeepers, you could probably cut back that department with Excel. But once you'd done that, that was about all you could do. It didn't really have a lot of applications for a lot of other businesses. So once we had that boost in output of computers and software, and then everybody had it and there wasn't any more of it, the whole thing kind of fizzled away. Also, in the late 1990s, a lot of companies went on a spending binge on IT because of the year 2000 problem. All the chief information officers used that as a great excuse to upgrade to the state-of-the-art computers and software at the time. And there was no Y2K problem as a result. And as a result, demand for technologies kind of fell off a cliff once we went into once the clocks changed and there was no problems and everybody had loaded up on technology. So that's I think what happened back then. And and now to the here and now, I would argue that technology that's available lends itself to increasing productivity in every business. I tell our accounts, look at your portfolio and look at every company in your portfolio as a technology company. They either make it or they use it. If they don't use it, they're going to be at a competitive disadvantage.
So, I mean, if you look back to that period, that mid to late 90s, as you say, we had the productivity boom and the Fed was kind of able to allow the economy to grow strongly without tightening, which is the kind of the scenario you're talking about now. And then obviously we had kind of a Wall Street guy at the Treasury in Robert Rubin. So certainly some parallels. I mean, that was an era of a strong dollar. I mean, we're hearing conflicting noises coming from Trump and his appointees with respect to kind of trade in the dollar. On the one hand, you've got Lighthizer involved on trade, and he wants to balance bilateral trade relations. Scott Bessent seems to be more pragmatic and in favor of or at least open to a stronger dollar. And Trump previously had talked about, talking down the dollar, but it seems to have changed his tone of late. So how do you see international policy, dollar policy playing out?
Yeah, I don't know if Lighthizer is involved anymore. He was in Trump 1.0. He may still be an advisor informally, but I don't think he's got an official position. I think Trump's appointed a younger trade negotiator, but Lighthizer certainly still has an influence on trade policy. But look, that's again gets back to the lots of moving parts here, is that if Trump does in fact impose a 10-20% tariff across the board, and much will depend on the reaction of the dollar. If the perception is that we have to own the dollar because so many countries are going to be at a disadvantage here by not being able to sell in the United States, or they're a competitive disadvantage. So if you get a stronger dollar, let's say the dollar goes up 10% and the import is 10%, the inflationary consequences might actually net out to zero. Somebody's still going to be paying that 10%, but it's not going to be inflationary. But I am bullish on the dollar, not to say it's going to go up and away, but I think it's going to remain strong, may get stronger. It's hard to get wildly excited about the euro, given what's going on in the politics and economic backdrop of that region. I think the idea that the BRICS are going to come up with an alternative currency, how shall I put it? It's a joke. I mean, the economy with the strongest economy gets to have the reserve currency. I mean, that's the way it's always worked, and that's not going to change very much. And who really wants to own a currency backed by Russia or even China? Right now, these are not stable economies. So I think the dollar does remain strong. I think the U.S. continues to remain a big factor in global stock markets. I think we now account for 75% of the market capitalization global stock markets. I mean, it's absolutely huge. As a contrarian, I'm constantly thinking about what could go wrong, what could suddenly make investing overseas a bit more appealing, and I can't really come up with it. But then I've been biased. I've been arguing since 2010 that from a U.S. perspective, we should overweight U.S. stocks relative to foreign stocks. I'm just saying stay home rather than go global, and it's worked remarkably well. It's working maybe better than I thought recently, and so it does kind of make me wonder how much longer can this go on? But I can't think of any reason why it shouldn't go on.
It's interesting. You touch on a few points that are kind of interesting from that perspective. You had, the Goldman report, which I know you addressed in some of your research as well, where they were forecasting 3% annualized returns, I think, for the S&P 500 for the next 10 years. And part of it was based on this concentration issue. I think the same guys are actually bullish on the market for the next kind of 12 months, but it's kind of on a 10-year view that they're pessimistic. I think you took issue with that analysis, or you kind of didn't buy into it.
Yeah, I mean, historically, the growth rate of the S&P 500, including dividends, which is important to include, has been 11%, and the Goldman people acknowledged that there was actually 13% over the past year. So we've been tracking along the historical growth rate all along. And I don't know that concentration changes that. Just because 7 great companies account for 30% of the S&P 500, I don't particularly see any reason why that would change the potential growth rate of the S&P 500. I have to be true to my school. If I'm going to talk about the roaring 2020s, I'm looking at better productivity, which is great for profit margins. I think economists, generally speaking, never give technology enough weight, enough respect. And technology really has been an extraordinarily important variable in understanding economic history and in understanding where we're going. So I think they may be missing that. They also have a commercial interest in telling all their customers that buying stocks, with very low commissions isn't going to get you a good return. Instead, look at all these alternative investments that we're creating in our other shops. So I wonder whether they might be somewhat biased in their recommendations. I don't have that luxury. I just have to talk about the markets, and I have nothing else to sell other than my opinions. And my opinion is that the stock market's going to do very well, continue to do very well. I admit the valuation multiples are stretched, and we could have certainly a correction along the way. I wouldn't be surprised if we have a nasty sell-off in January, just because people have so many capital gains that they're going to want to rebalance. That you're not going to want to have so much in NVIDIA, so much in Tesla, but there could be a natural tendency to want to sell some of these. But why sell it now when you have to pay taxes on the capital gains immediately in April, when it might be better just to sell in January? But that'll be just a buying opportunity. That wouldn't be anything to try to market time.
Obviously you talk about the possibility of a melt up, and as you alluded to earlier, a melt up means that then at some point it melt down. So, we certainly saw that in the late 90s. Obviously, it ultimately ended in a big reversal in 2000, but along the way, in 97, there was decent corrections, and then obviously in 98, LTCM and the Russian debt default. Even in the roaring 20s scenario, a bullish scenario, presumably we'd have 20-30% drawdowns along the way. Or are you thinking more in terms of kind of 10 to 15% corrections? Or
yeah, I'm thinking more corrections. Bear markets are caused by recessions. And for the past 3 years, as you know, we've had the most widely anticipated recession of all times that didn't happen. As I call it, the Godot recession. Unfortunately, we were on the right side of that. But most people were sure we were going to have a recession because it made sense that tightening of monetary policy has always in the past caused the recessions. This time, for lots of reasons that we came up with, that was not the case. So if monetary policy isn't tightening now, and maybe they'll listen to us and just kind of leave things alone as is, but they're more inclined to lower rates. So we're not going to get a recession caused by a tight monetary policy anytime soon. We've had geopolitical risks that haven't led to a spike in oil prices, which has been another way to get recessions. So that kind of leaves us with Smoot-Hawley tariff, with Trump's tariffs as a potential cause of a recession. But our opinion is that's not going to happen. So I'm kind of hard pressed to say, well, what's going to cause a recession between now and the end of the decade? So I'm thinking if there's no recession, there's no bear market. But that doesn't mean we couldn't have, 10, 15% corrections along the way.
Yeah. I mean, it's interesting. You mentioned, as you say, bear markets normally caused by recessions, and there are arguments put forward by economists as why the economy is less recession prone these days. It's obviously more a service driven economy, so you don't have this kind of manufacturing cycle managing inventories. And I know you've written about kind of often the recession is some kind of credit crisis, or where the Fed has to respond, and now the Fed seems to have better crisis management tools, so that kind of takes that one away as well. So, I mean, if you think about it, then, so what happens in that scenario? Do valuations then just go to more extremes because we live in better times for longer periods? Is that how it plays out?
Yeah. Honestly, I am a little bit uncomfortable here with a couple of things. Valuations are stretched; they are near record. I mean, the Buffett ratio, which is the S&P 500 divided by revenues per share, its price to sales ratio, is at an all-time record high of 2.9. Buffett in the past said 2.0 is about as high as he wants to see it. And it does unnerve me to see somebody as smart as Warren Buffett raising a lot of cash. I mean, the only obvious explanation for that is he had a lot of cash before. I couldn't find anything to buy because everything was too expensive. So he came to the conclusion, well, if I can't find anything to buy, why do I own all these things that are expensive? And why don't I sell them and wait for an opportunity to buy them cheaper? So that is a concern. And this guy has an amazing track record. Another concern is we are seeing speculative excesses other than valuation multiples in areas like Bitcoin, and the ARK funds are starting to get hot again. So those are issues. I'm not telling anybody that stocks are cheap here. I'm just saying that I think the economy is going to get boosted by productivity, which is going to show up in earnings. And so I'm looking for an earnings-led melt-up, which isn't a melt-up at all, right? It's valuation-led melt-ups that we need to be concerned about. And we could have a melt-up followed by a meltdown, but it doesn't necessarily have to be 1999, 2000 all over again. It could be, I suppose, a bear market melt up followed by a meltdown would be presumably more than a correction, but it could be pretty short lived. And again, it could be pretty hard to play that. Getting out at the top is great if you can do that, but then you also have to be smart enough to get in at the bottom. Otherwise, you're just going to miss the move up. We've just seen that in 2022 when some people called the top and just forgot to tell anybody to get back in.
It's interesting. I mean, I just say there are these signs of excess. I mean, obviously credit spreads are very tight as well, and that's obviously a positive for the economy. In terms of the cost of capital, and then obviously as the stock market goes up, that creates wealth as well. But obviously, as things like Bitcoin, Dogecoin, all of these things. I mean, where do you stand on crypto? Do you think Bitcoin has now established itself as a feature of the landscape? Is it here now that it's at 100,000?
Yeah, I think whenever you ask somebody that, you have to ask them whether they own any or not. And if they
exactly.
don't, they're going to badmouth it because they missed a great. So I don't, but I'm not going to badmouth it. For quite some time, I've been calling it digital tulips, which sounds like I'm badmouthing it because then I'm saying, well, this is just another bubble like the tulip bubble. But actually, if you think about it, the tulip bubble was basically in Amsterdam, and the market was open during the day, wasn't open at night. And once everybody that wanted to be speculated had a tulip bulb, you kind of ran out of buyers, and the whole thing kind of imploded. So now let's take this example and say, okay, so what is a digital tulip mania look like? Well, the big difference is that it's global. So you got a lot more people like that are potential buyers. I don't want to jinx it for anybody. Once I buy, I should kind of announce it to the world, and that'll be the top. but so there's still plenty of potential buyers. And like the tulip mania, and by the way, it's open 24/7. And like the tulip mania, there's there's no fraud involved. Everybody knew what they were getting. There's no Ponzi involved, so it's not kind of the classic mania in that regard. So that's kind of where we are. I mean, and then of course, in the tulip mania, to my knowledge, the municipal government didn't say we're going to create a government reserve for bulbs the way that Donald Trump has said. So now that politicians are jumping in, and he said it because he wanted the crypto voters to say, "Hey, he's one of us," and so he got that vote. And what does it mean if they buy Bitcoin? I guess Trump could imagine a scenario where they do kind of the micro strategy game and instead use tax. Well, they borrow money in the treasury market. They put it in Bitcoin. Bitcoin goes up. They borrow more money. They put more money in Bitcoin. And then when they think they got enough, they say, "Hey, we're going to pay off all the debt." Well, try to do that and get out of all the Bitcoin to do that. So I don't know. Could it go to 1 million? Sure, why not? I mean, I don't know.
Yeah. Well, I'm trying to remember my economic history. I think tulips, because these were rare tulips. It wasn't just any old tulip that they were buying. They were very rare. I think they traded for nearly about the cost of a house. So maybe Bitcoin can go to 300,000 or 400,000 based on that kind of metric, if that's the case.
Yeah. I mean, it's a conundrum. I want to say for all your listeners that Yardeni Research is seriously considering issuing convertible bonds at 0% and buying Bitcoin. I mean, if MicroStrategy can play that game, why can't anybody play that game? And, so Bitcoin goes up and then my stock price goes up and then I issue more stock and I buy more Bitcoin. So the guy's discovered, the fountain of youth. I mean, it's El Dorado.
Financial alchemy, yeah. I mean, one of the reasons people point to the bullish case for Bitcoin, I suppose, relates back to one of your specialist topics, which is debt and the deficit and the fact that we have such large debts and ongoing deficits, and that's going to require ongoing liquidity provision from central banks. So, and because of that, all of the monetary stimulus will go into real assets, and obviously Bitcoin is seen as kind of a digital gold in that respect. I mean, are you sympathetic to that view? I mean, would you be bullish on gold from the same perspective, or is that a valid argument?
I think gold has been held back by Bitcoin because why play with gold when you can play with digital currency? But I think there's a lot of similarities there. I don't know what gold is worth, and all I think I know is ever since Russia invaded Ukraine and we slapped sanctions on them, especially confiscated their reserves, or at least froze them. Central banks have said, well, if the U.S. turns against us, we'd rather have our reserves in gold. So that seems to be what's driving the gold price up. And so there's no, other than kind of geopolitical concerns, there's nothing, there's no fundamental demand by these central banks to buy gold to make jewelry or do something industrial with it. So I think Bitcoin has actually held gold back in some ways. But yeah, sure. I mean, I have no problems with gold. I know the same thing that everybody else knows. China and other central banks are buying gold, so the gold price is going to go up, and that's the story.
I mentioned at the outset you were on last year around kind of the October time, and bonds had been under pressure and yields had been rising. And the big change that seemed to turn the market at the time was the change pattern of treasury issuance, so shifting more towards bills away from coupons. And I mean, there was a paper out then. We had Steve Murren on here as a guest as well. Him and Rubini wrote a paper suggesting this was a treasury tactic. I mean, do you buy that, or how do you see what the Treasury has been doing? Yeah.
Yeah, I got a PhD from Yale 6 years after Janet Yellen did. And I got through Yale because of Janet Yellen. She took meticulous notes of Professor James Tobin's class. I didn't understand anything he was saying, but her notes were brilliant. And so I thank her for getting me through that. She's a very bright lady. And so she's Treasury Secretary. And last year, November 1st, she basically said to the bond vigilantes, well, if you don't like my bonds, I'll just do more bills. And seems to be an infinite demand for bills. There's no problems getting U.S. Treasury bills sold. So that took the pressure off. Though suddenly there weren't going to be as many bonds being issued. And meanwhile, inflation also kind of moderated. So that was a big contributor as well. So that's what happened on November 1st. And, people like Ray Dalio were going around really looking very, very concerned that we were on the edge of a debt crisis. And it kind of felt like it there for, going from 4 to 5% in a couple of months is very unnerving. And that just didn't play out. And I think the Trump administration has bought some time on getting the bond vigilantes to stand down with some of the promises they've been making of what they're going to look into in order to, at least they seem to care about reducing the deficit. I mean, it's conceivable that Trump will become just as sensitive to the bond vigilantes as Bill Clinton was. Bill Clinton, as you said, was warned by Robert Rubin and James Carville, don't mess with the bond vigilantes, don't mess with the bond market. And I think Trump is going to be told that by his advisors like Bassett.
Okay. Yeah, it's interesting. I think the BIS and Claudio Borio were out today warning that you have to see progress on deficit reduction, that you can't just leave it to the markets to enforce it. So I guess it'll be an interesting, because obviously I think, and even I think Scott Bessent has alluded to this, that whether the Treasury can actually term out those bonds that those bills that they've issued is obviously going to be an interesting challenge for them.
It's never comes with a money back guarantee. I try to be balanced. Nevertheless, I'm often characterized as a permabull, which is okay by me. I view that as a compliment because on balance, the stock market goes up. And I've been pretty good at calling bottoms. I'm still working on calling tops. And again, that's the problem I have with the permabulls. Even if they tell you when to get out, they'll never tell you to get back in, and you'll miss a lot of wealth creation.
Absolutely. So, I mean, for listeners, for readers who want to follow your work more closely, where's the best place to keep track of your work?
Yeah, well, we have for the past couple of years have a research product for individual investors. It's called YardeniQuickTakes.com.
Okay, great. Well, Ed, thanks very much for coming on here today. It's been a great conversation. And so for all our listeners, make sure to check out YardeniQuickTakes.com to keep track of Ed's work, as we are no doubt living in a macro-driven world. So from all of us here at Top Traders Unplugged, stay tuned and we'll be back soon with more content.
Thank you, Alan.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.